Question 1. Legal and regulatory framework. Which of the following is a key requirement for forming a captive insurance company in Louisiana under state law? A. The captive must have a minimum of $1 million in paid-in capital and surplus. B. The captive must be owned exclusively by a single policyholder. C. The captive must submit an annual feasibility study to the Louisiana Department of Insurance (LDI). D. The captive must obtain approval of its investment strategy from the Commissioner of Insurance. Answer A. The captive must have a minimum of $1 million in paid-in capital and surplus. Explanation. Under Louisiana law, a key requirement for forming a captive insurance company is maintaining adequate financial reserves to ensure solvency. Specifically, a minimum of $1 million in paid-in capital and surplus is mandated. This ensures the captive's financial stability and its ability to meet policyholder obligations. Option B is incorrect because ownership structures can vary, e.g., single-parent group captives and ownership by a single policyholder is not a universal requirement. Option C is incorrect because feasibility studies are typically required during the application process but not annually thereafter. Option D is incorrect because while investment activities must comply with state regulations, there is no requirement for prior approval of the strategy by the Commissioner. A relevant rule, Louisiana Revised Statutes La. SS 550.4 outlines these requirements for captive formation. Question 2. Scenario-based. Risk management and coverage. Marfa Corp., a large technology firm based in Louisiana, seeks to establish a captive insurance company to manage its professional liability risks. After forming the captive, Marfa Corp. faces a significant cyber attack leading to claims of $2 million against its captive. The company is unsure whether these claims fall under professional liability or cyber risk insurance. How should Marfa Corp. proceed in assessing the claims? A. Deny the claims entirely because professional liability and cyber risk insurance are separate coverages. B. Pay the claims under professional liability coverage because it overlaps with cyber risks. C. Conduct a detailed review of the captive's policy wording to determine coverage applicability. D. Submit the claims to an external reinsurer for assessment before payment. Answer. C. Conduct a detailed review of the captive's policy wording to determine coverage applicability. Explanation. The resolution of claims in a captive insurance arrangement depends on the specific terms and conditions outlined in the captive's policy documents. Reviewing the policy wording will clarify whether the claims related to the cyber attack are covered under professional liability insurance, cyber risk insurance, or neither. Option A is incorrect because it assumes a lack of coverage without examining the policy, which is improper. Option B is incorrect because professional liability and cyber risks are distinct and coverage cannot be assumed without policy verification. Option D is incorrect because external reinsurers assess reinsured risks, not direct claims within a captive. Relevant rule. Louisiana statutes on captive operations emphasize the importance of clear policy language and claims adjudication processes. SS 550.6. Question 3. Financial management of captive insurance. A captive insurance company in Louisiana is setting reserves for potential claims. If the expected claims over the next year are estimated at $1,500,000 with a variance of $200,000, which of the following reserve levels should the captive set to comply with solvency requirements and prudent risk management practices? A. $1,200,000. B. $1,500,000. C. $1,700,000. D. $2 million. Answer. D. $2 million. Explanation. Setting reserves involves accounting for both expected claims and a margin for variability to ensure solvency and adherence to prudent risk management practices. While the expected claims are $1,500,000, adding the variance, $200,000, plus an additional buffer ensures compliance with solvency guidelines and readiness for unexpected adverse developments. A reserve level of $2 million reflects this prudence. Option A is incorrect because it does not cover the expected claims and indicates under-reserving. Option B is incorrect because it matches only the expected claims, lacking a margin for variability. Option C is incorrect because it accounts for the variance but lacks an adequate solvency buffer. Relevant rule. Louisiana Revised Statutes SS 550.10 requires captives to maintain reserves sufficient to cover all liabilities, including a margin for unexpected events. Question 4. Captive insurance operations. Which of the following best describes the role of an actuary in a captive insurance company's operations? A. Drafting the captive's articles of incorporation and bylaws. B. Conducting risk assessments and determining appropriate premium levels. C. Managing day-to-day claims processing and settlements. D. Preparing financial audits for regulatory filings. Answer: B. Conducting risk assessments and determining appropriate premium levels. Explanation: Actuaries play a crucial role in captive insurance by analyzing risk exposure and ensuring that premiums are adequate to cover potential losses while maintaining solvency. Their expertise is vital for sound financial planning and reserve setting. Option A is incorrect because drafting corporate governance documents is typically handled by legal advisors. Option C is incorrect because claims processing is managed by the claims department or outsourced administrators. Option D is incorrect because financial audits are conducted by independent auditors, not actuaries. Relevant rule: actuarial studies are often mandated by Louisiana's captive regulations for feasibility and reserve adequacy analysis (LA SS 550.5). Question 5. Governance and oversight. Which of the following is a requirement for the board of directors of a captive insurance company domiciled in Louisiana? A. At least one board member must reside in Louisiana. B. The board must consist exclusively of individuals employed by the captive's parent company. C. The board must meet monthly to discuss regulatory compliance. D. The board must have an external auditor as a voting member. Answer A. At least one board member must reside in Louisiana. Explanation: Louisiana regulations require that at least one director of a captive insurance company be a resident of the state to ensure compliance with local laws and maintain effective oversight. Option B is incorrect because board members can include external experts or independent members. Option C is incorrect as monthly meetings are not mandatory. Meeting frequency is typically specified in the bylaws. Option D is incorrect because external auditors are not required to serve as voting members of the board. Relevant rule: SS 550.9 outlines the governance requirements for captives, including the residency provision. Question 6. Scenario-based taxation of captive insurance. James Enterprises has a captive insurance company in Louisiana qualifying under Section 831(b) of the Internal Revenue Code. This year, the captive collected $1,950,000 in premiums. Which of the following is the most accurate tax implication for the captive under Section 831(b)? A. The captive's underwriting income is taxed at the corporate tax rate. B. The captive's premium income is exempt from federal income tax. C. The captive pays no tax on premiums but must report investment income for taxation. D. The captive must file as a standard insurance company for tax purposes. Answer: C. The captive pays no tax on premiums but must report investment income for taxation. Explanation: Under Section 831(b), captives meeting the criteria, premium income not exceeding $2.65 million annually adjusted for inflation, can elect to exclude premium income from federal taxation. However, they are still required to pay taxes on investment income. Option is incorrect because underwriting income from premiums is excluded under the election. Option B is incorrect because investment income remains taxable. Option D is incorrect as Section 831(b) provides a specific tax election for qualified captives. Relevant rule: Internal Revenue Code Section 831(b) governs the tax treatment of small captives. Question 7. Reinsurance and fronting arrangements. Why might a captive insurance company in Louisiana enter into a fronting arrangement with a licensed insurer? A. To reduce its regulatory compliance obligations. B. To obtain access to admitted insurance markets and issue policies directly to third parties. C. To avoid maintaining adequate reserves for claims. D. To bypass the need for reinsurance agreements. Answer: B. To obtain access to admitted insurance markets and issue policies directly to third parties. Explanation: A fronting arrangement allows captives to access admitted markets by partnering with a licensed insurer that issues the policy on behalf of the captive. This enables the captive to fulfill regulatory and client requirements while managing risk internally. Option A is incorrect because captives still have compliance obligations despite fronting arrangements. Option C is incorrect because adequate reserves are mandatory under Louisiana law. Option D is incorrect because captives often use reinsurance even when engaging in fronting arrangements. Relevant rule: Fronting arrangements are recognized under LA SS 550.13 provided they meet regulatory and financial standards. Question 8. Emerging trends and issues. Which of the following best exemplifies how captives can address emerging risks such as cyber threats? A. Replacing traditional property insurance with a captive arrangement. B. Providing customized coverage for cyber liability tailored to specific organizational risks. C. Focusing exclusively on regulatory compliance rather than risk mitigation. D. Operating as a reinsurer for unrelated entities' cyber liability policies. Answer. B. Providing customized coverage for cyber liability tailored to specific organizational risks. Explanation. Captives are highly effective in managing emerging risks like cyber threats due to their ability to design customized policies that align with specific organizational needs. They can provide tailored coverage for areas not fully addressed by traditional insurers. Option A is incorrect because cyber risks and property insurance address different exposures. Option C is incorrect as captives focus on risk mitigation in addition to compliance. Option D is incorrect because captives primarily serve their parent organizations and not unrelated entities. Relevant rule. Captives are increasingly utilized for managing risks like cyber liability under Louisiana insurance law, SS 550.14. Question 9. Captive feasibility information. During the feasibility study for a proposed Louisiana-domiciled captive, which of the following is the primary consideration? A. Ensuring the captive will exclusively cover low-frequency, low-severity risks. B. Evaluating the financial viability and potential risks to the parent company. C. Determining the types of unrelated risks the captive will underwrite. D. Calculating potential tax benefits as the sole determining factor. Answer. B. Evaluating the financial viability and potential risks to the parent company. Explanation. A feasibility study must assess the captive's financial viability, risk exposure, and alignment with the parent company's overall risk management strategy. This includes actuarial analyses, financial projections, and regulatory compliance considerations. Option A is incorrect because captives often cover high-frequency or high-severity risks. Option C is incorrect because captives typically focus on related risks. Option D is incorrect because tax benefits are only one of many factors in the study. Relevant rule. SS 550.6 outlines feasibility requirements, including risk and financial analysis. Question 10. Taxation of captive insurance. What is the primary purpose of the premium tax imposed on captives in Louisiana? A. To ensure captives maintain adequate reserves for claims. B. To generate state revenue while regulating captive operations. C. To penalize captives for engaging in risk retention. D. To fund federal oversight of captive insurers. Answer. B. To generate state revenue while regulating captive operations. Explanation. Premium taxes on captives serve to generate revenue for the state while ensuring captives are accountable in their financial operations. These taxes are an integral part of the regulatory framework but are not punitive. Option is incorrect because premium taxes are unrelated to reserve requirements. Option C is incorrect because the taxes are regulatory, not punitive. Option D is incorrect because premium taxes are state level and not used for federal purposes. Relevant rule. Louisiana imposes a premium tax on captives as part of its regulatory structure. SS 550.8. Question 11. Captive insurance operations. Which of the following best defines the concept of risk retention in the context of captive insurance? A. Transferring risk to a reinsurer while keeping claims management in-house. B. Retaining risks within the captive without purchasing external insurance or reinsurance. C. Selling parts of the captive's risks to third-party investors. D. Transferring all risks back to the parent company during insolvency. Answer. B. Retaining risks within the captive without purchasing external insurance or reinsurance. Explanation. Risk retention occurs when a captive assumes responsibility for managing and paying for certain risks rather than transferring them to a traditional insurer or reinsurer. This allows for cost savings and greater control over claims management. Option A is incorrect because it describes a combination of retention and transfer, not pure retention. Option C is incorrect because captives do not typically sell risks to investors. Option D is incorrect because transferring risks back to the parent is not a standard practice. Relevant rule. Risk retention aligns with the regulatory definition under SS 550.5 Emphasizing internalized risk management. Question 12. Legal and regulatory framework in Louisiana. What is the minimum capital and surplus requirement for forming a captive insurance company? A. $100,000. B. $250,000. C. $1 million. D. It varies depending on the type of captive. Answer D. It varies depending on the type of captive. Explanation: Louisiana's regulations specify different capital and surplus requirements depending on the type of captive. E.g., pure group or protected cell. For example, pure captives may require $250,000, while group captives might require more. Option is incorrect because it is below the minimum threshold for any captive type. Option B is incorrect as it applies only to certain types of captives. Option C is incorrect because this is not a universal requirement. Relevant rule, SS 550.7 outlines capital requirements specific to various captive structures. Question 13, scenario-based. Risk management and coverage. Maria Enterprises operates a manufacturing plant with a high exposure to workers' compensation claims. The captive insurance company in Louisiana is considering adding workers' compensation coverage. What must the captive insure before offering this coverage? A. That it has a fronting carrier agreement with an admitted insurer. B. That workers' compensation coverage is excluded from Louisiana's insurance statutes. C. That the captive complies with all reinsurance treaty obligations. D. That the captive has sufficient capital and meets statutory requirements for providing this coverage. Answer D. That the captive has sufficient capital and meets statutory requirements for providing this coverage. Explanation: before offering workers' compensation coverage, a captive must meet specific regulatory and capital requirements to ensure it can pay claims and remain solvent. Workers' compensation is heavily regulated and compliance is critical. Option A is incorrect because a fronting arrangement is not mandatory for all workers' compensation coverage. Option B is incorrect because workers' compensation is not excluded from Louisiana statutes. Option C is incorrect because reinsurance treaties are secondary considerations. Relevant rule: SS 550.5 and SS 550.9 govern the provision of workers' compensation coverage by captives. Question 14. Financial management. What is the primary purpose of establishing reserves in a captive insurance company? A. To cover administrative expenses and premium taxes. B. To ensure the captive can pay future claims. C. To finance investments in parent company operations. D. To guarantee dividends to the captive shareholders. Answer: B. To ensure the captive can pay future claims. Explanation: reserves are funds set aside by captives to cover expected claims and potential liabilities. These reserves are critical for maintaining solvency and meeting regulatory requirements. Option A is incorrect because reserves are not used for administrative expenses. Option C is incorrect because using reserves for parent company operations would breach regulations. Option D is incorrect because shareholder dividends are secondary to solvency. Relevant rule: reserve requirements are outlined in SS 550.10 to ensure financial stability. Question 15. Taxation. How does Louisiana's treatment of premium taxes for captives differ from traditional insurers? A. Captives are entirely exempt from premium taxes. B. Captives pay premium taxes at a lower rate than traditional insurers. C. Captives pay additional surcharges on premium taxes. D. Premium taxes are not applicable to any insurer in Louisiana. Answer: B. Captives pay premium taxes at a lower rate than traditional insurers. Explanation: Louisiana offers captives a more favorable tax environment by imposing low premium tax rates compared to traditional insurers, encouraging captive formation within the state. Option A is incorrect because captives are not entirely exempt. Option C is incorrect because no additional surcharges apply specifically to captives. Option D is incorrect as premium taxes are a requirement for insurers in Louisiana. Relevant rule: SS 550.8 outlines the premium tax obligations for captives. Question 16. Captive feasibility information. Which document is not required during the application process for forming a captive in Louisiana? A. A feasibility study report. B. Articles of incorporation. C. A business plan. D. Quarterly claims history of the parent company. Answer D. Quarterly claims history of the parent company. Explanation: while claims data may be included in the feasibility study, the submission of a detailed quarterly claims history is not explicitly required during the application process. Essential documents include the feasibility study, articles of incorporation, and business plan. Relevant rule: application requirements for captives are outlined in Lat. SSS 550.4. Question 17. Reinsurance. A Louisiana-domiciled captive is considering a quota share reinsurance agreement. Which of the following describes this arrangement? A. The captive retains all risks and uses reinsurance only for catastrophic claims. B. The captive shares a proportional amount of premium and risk with the reinsurer. C. The reinsurer assumes risks only above a specified dollar amount. D. The captive purchases reinsurance only for operational expenses. Answer: B. The captive shares a proportional amount of premium and risk with the reinsurer. Explanation: in a quota share arrangement, the captive and reinsurer agree to share premiums and claims proportionally. This approach spreads risk and reduces the captive's financial exposure. Option A is incorrect because it describes excessive loss reinsurance. Option C is incorrect because it refers to non-proportional reinsurance. Option D is incorrect because operational expenses are not typically covered by reinsurance. Relevant rule: Lat. SS 550.13 governs reinsurance arrangements for captives. Question 18. Governance. Which of the following is a required component of corporate governance for a Louisiana captive? A. The captive must have a minimum of 10 directors. B. The captive must implement an internal audit process. C. The captive must appoint the Louisiana Commissioner of Insurance as its primary legal advisor. D. The captive must conduct annual shareholder meetings. Answer: B. The captive must implement an internal audit process. Explanation: internal audits are essential for ensuring compliance with regulations and maintaining effective oversight of financial and operational processes. Option is incorrect because no specific number of directors is mandated. Option C is incorrect because the commissioner is not a legal advisor for captives. Option D is incorrect as shareholder meetings are not explicitly required by Louisiana law. Relevant rule: corporate governance requirements are outlined in Lat. SS 550.9. Question 19. Emerging trends. How can Louisiana captives use protected cell structures to manage risks more effectively? A. By pooling unrelated risks within the same parent company's captive. B. By segregating assets and liabilities for different participants within the captive. C. By eliminating the need for reinsurance agreements. D. By using the structure exclusively for federal tax benefits. Answer: B. By segregating assets and liabilities for different participants within the captive. Explanation: protected cell structures allow a captive to segregate assets and liabilities, providing legal and financial protection for each cell. This is particularly useful for group captives or association captives. Relevant rule: protected cell captives are regulated under SSS 550.16. Question 20. Risk management. What is a key advantage of using captives to ensure cyber risks? A. Captives eliminate the need for encryption technologies. B. Captives provide tailored coverage not available in traditional markets. C. Captives are exempt from regulatory oversight for cyber risks. D. Captives guarantee 100% reimbursement for all cyber losses. Answer: B. Captives provide tailored coverage not available in traditional markets. Explanation: captives offer the flexibility to design bespoke policies that address specific cyber risk exposures faced by the parent company or its subsidiaries. Traditional insurance markets may not provide comprehensive or cost-effective coverage for emerging or niche cyber threats. Option is incorrect because encryption is still essential for cybersecurity and unrelated to insurance coverage. Option C is incorrect because captives must comply with regulatory requirements for all risks, including cyber risks. Option D is incorrect because no insurance arrangement, including captives, guarantees full reimbursement for all losses, and coverage is limited by policy terms and conditions. Relevant rule: while Louisiana statutes such as SS 550.5 do not explicitly address cyber risks, they allow captives to offer customized coverage for diverse exposures, including cyber risks. Question 21. Financial management. Which of the following is a key consideration in setting reserves for a Louisiana captive insurance company? A. Ensuring reserves are sufficient to cover worst-case catastrophic losses. B. Following Louisiana's specific statutory accounting requirements for captives. C. Avoiding the inclusion of reinsurance recoverables in reserve calculations. D. Setting reserves equal to the premium received for the policy period. Answer: B. Following Louisiana's specific statutory accounting requirements for captives. Explanation: Louisiana captives must comply with the state's statutory accounting principles (SAP) to determine reserve adequacy. This ensures reserves meet regulatory requirements and reflect the company's financial health. Option A is incorrect because while reserves should consider catastrophic risks, they are not solely based on worst-case scenarios. Option C is incorrect because reinsurance recoverables must be considered to accurately assess reserve sufficiency. Option D is incorrect because reserves are calculated based on projected liabilities, not merely the premium collected. Relevant rule: Louisiana's insurance regulations under LA.S. SS 550.16 emphasize reserve adequacy for financial solvency. Question 22. Legal and regulatory framework. Under Louisiana law, what is the primary role of the Commissioner of Insurance in relation to captive insurance companies? A. Determining premium pricing for captive policies. B. Providing risk management services to captives. C. Approving the formation and licensing of captives. D. Offering tax incentives for captive insurance companies. Answer: C. Approving the formation and licensing of captives. Explanation: the Louisiana Commissioner of Insurance oversees captive insurance operations, ensuring compliance with state regulations. This includes reviewing applications, business plans, and governance structures before granting licenses. Option A is incorrect because premium pricing is determined by the captive, not the commissioner. Option B is incorrect because risk management services are typically managed by the captive's team or third-party providers. Option D is incorrect because tax incentives may exist but are not the primary responsibility of the commissioner. A relevant rule, LA.S. SS 550.4 mandates commissioner approval for captive formation and licensing. Question 23. Reinsurance and fronting arrangements. Why might a Louisiana captive insurance company use a fronting carrier? A. To completely avoid regulatory scrutiny. B. To access broader reinsurance markets. C. To eliminate the need for financial reporting. D. To retain all risk without transferring it. Answer: B. To access broader reinsurance markets. Explanation: a fronting carrier issues policies on behalf of the captive, allowing the captive to access reinsurance markets that may otherwise be unavailable. This enhances risk management and capital efficiency. Option A is incorrect because captives using fronting carriers remain subject to regulatory oversight. Option C is incorrect because financial reporting requirements still apply to both the captive and the fronting carrier. Option D is incorrect because captives often use fronting carriers to transfer portions of the risk via reinsurance. Relevant rule: reinsurance arrangements for captives are guided by Louisiana Department of Insurance regulations under LA.S. SS 550.8. Question 24. Scenario-based taxation. Patricia owns a small business in Louisiana and recently formed a captive insurance company under Section 831(b) of the Internal Revenue Code. What limitation must Patricia be aware of when determining her captive's premium income for tax purposes? A. The premium income cannot exceed $1 million annually. B. The premium income must exactly match the parent company's total insurable risk. C. The premium income cannot exceed $2.65 million annually. D. The premium income must include investment income from the captive's reserves. Answer: C. The premium income cannot exceed $2.65 million annually. Explanation: under Section 831(b) of the IRC, small captives electing this tax treatment are limited to $2.65 million in annual premium income adjusted for inflation. Exceeding this threshold disqualifies the captive from the tax benefits under this section. Option is incorrect because the limit is higher than $1 million. Option B is incorrect because the premium income does not need to match total insurable risk. Option D is incorrect because investment income is separate from premium income and is taxed differently. Relevant rule: Section 831(b) of the IRC defines the tax benefits and limitations for small captives. Question 25. Risk management and coverage. Which of the following is a key benefit of a captive insurance company providing workers' compensation coverage to its parent company? A. Full exemption from federal reporting requirements. B. Elimination of workers' compensation claims. C. Greater control over claims management and safety programs. D. Avoidance of Louisiana Department of Insurance regulations. Answer: C. Greater control over claims management and safety programs. Explanation: captives offer their parent companies the ability to implement customized claims management processes and safety initiatives, potentially reducing costs and improving workplace safety. Option A is incorrect because captives must still meet federal reporting obligations. Option B is incorrect because claims cannot be eliminated, that they can be better managed. Option D is incorrect because captives are subject to Louisiana Department of Insurance oversight. Relevant rule: workers' compensation provided by captives must comply with Louisiana labor laws and insurance regulations. Question 26. Captive feasibility and formation. Which document is critical during the formation of a captive insurance company to justify its economic viability? A. Articles of Incorporation. B. Feasibility study. C. Reinsurance treaty. D. Board meeting minutes. Answer: B. Feasibility study. Explanation: the feasibility study assesses the captive's financial and operational viability, ensuring that it can meet its obligations and serve its intended purpose. This includes risk analysis, cost projections, and market evaluation. Option A is incorrect because articles of incorporation are necessary for legal formation but do not assess feasibility. Option C is incorrect because a reinsurance treaty is part of ongoing operations, not initial formation. Option D is incorrect because board minutes document decisions but do not evaluate viability. Relevant rule: Louisiana captive regulations require feasibility studies as part of the application process under LA R.S. SS 550.5. Question 27. Governance and oversight. What is a primary responsibility of the board of directors in a Louisiana captive insurance company? A. Performing actuarial analyses for reserve adequacy. B. Monitoring and ensuring the captive complies with regulatory requirements. C. Setting premium tax rates for the captive. D. Providing reinsurance to other insurance companies. Answer: B. Monitoring and ensuring the captive complies with regulatory requirements. Explanation: the board of directors is responsible for ensuring the captive adheres to state and federal regulations, overseeing governance and maintaining operational integrity. Option A is incorrect because actuarial analyses are conducted by actuaries, not the board. Option C is incorrect because tax rates are determined by law, not by the captive's board. Option D is incorrect because captives typically seek reinsurance rather than provide it to others. Relevant rule: LA R.S. SS 550.16 requires captive boards to maintain compliance and ethical governance standards. Question 28. Emerging trends and issues. How are Louisiana captives increasingly being used to manage cyber risks? A. By reducing compliance obligations for data breach laws. B. By offering coverage tailored to evolving cyber threats. C. By eliminating the need for traditional cybersecurity measures. D. By transferring cyber risks to federally funded reinsurance pools. Answer: B. By offering coverage tailored to evolving cyber threats. Explanation: captives allow businesses to customize policies that address specific cyber risks, which are often inadequately covered by traditional insurers. This flexibility enables companies to respond to evolving threats effectively. Option A is incorrect because captives do not reduce compliance with data breach laws. Option C is incorrect because captives complement, not replace, cybersecurity measures. Option D is incorrect because federal reinsurance pools for cyber risks do not exist. A relevant rule: Louisiana statutes permit captives to underwrite non-traditional risks, including cyber liability under LA R.S. SS 550.7. Question 29. Scenario-based. Financial management. Anderson Holdings operates a group captive in Louisiana. During an audit, the company discovered that its reserves for property insurance claims were underestimated by 15%. What should the captive's management do to address this issue? A. File for bankruptcy due to reserve shortfalls. B. Adjust reserves and inform the Louisiana Department of Insurance. C. Continue operating without adjustment to avoid drawing attention. D. Use retained earnings to cover future claims without adjusting reserves. Answer: B. Adjust reserves and inform the Louisiana Department of Insurance. Explanation: reserves must be adjusted to accurately reflect liabilities, and regulatory authorities must be informed to ensure ongoing compliance. Failure to adjust reserves can lead to financial instability and regulatory penalties. Option A is incorrect because reserve shortfalls alone do not necessitate bankruptcy. Option C is incorrect because operating without adjustment violates Louisiana insurance regulations. Option D is incorrect because using retained earnings does not address reserve accuracy. Relevant rule: reserve adequacy and compliance are governed under La R.S. SS 550.8. Question 30. Taxation of captive insurance. Which factor is crucial in determining the premium tax owed by a Louisiana captive insurance company? A. The number of claims paid in the prior fiscal year. B. The gross premiums written by the captive. C. The investment income earned by the captive. D. The total administrative expenses incurred by the captive. Answer: B. The gross premiums written by the captive. Explanation: premium taxes for Louisiana captives are calculated based on gross premiums written as specified by state tax laws. Other financial metrics, such as investment income or expenses, do not directly impact premium tax calculations. Option A is incorrect because claims paid do not influence premium tax. Option C is incorrect because investment income is taxed differently. Option D is incorrect because administrative expenses do not affect premium tax liability. Relevant rule: La R.S. SS 550.14 establishes the premium tax framework for captive insurance companies in Louisiana.